Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun. Test. Okay, that's weird. I messed up the volume settings. That's super weird. Guys, what was I saying? I know that every time we have a non-farms payroll, I'm like, this is the big one. This non-farms payroll is the big one that matters. Is going to make or break. This time, it really is, okay? If this number comes in and it is a weak number, then that is the economy is going into a recession. The Federal Reserve is going to cut interest rates, sell everything, buy treasuries. It will be absolute chaos. If this number comes in strong, then the soft landing is back on the table. Federal Reserve is only going to cut interest rates 25 basis points. Treasuries probably sell off a little bit. And the markets, I think, will probably rally. So this is a big number. I have to warn you, if you're new, okay, this event is going to be extremely volatile. I would not recommend having your money on the line going into that number because it is going to move so much it can blow your account in an instant. Okay, if you're on a combine, like, go for it. Because if you're right, if you're on a combine, buy the treasuries and sell everything else. Because I think that the number is probably going to be weak, and you'll probably pass your combine. Okay, but if it's your own money, don't do the degenerate thing. Okay, now here to remind me, I have the door open for a little bit because it's a little hot in here, and I forgot to open the door. So gonna let the air come in here a little bit to try and cool things down. Also, I'm having issues with these headphones. And remember, we got new headphones because these headphones over here, I got to be careful holding them because they'll fall apart. These headphones, I only get sound out of one ear. Well, now I'm only getting sound out of one ear on these now too. So, what I did yesterday, I did get an update on my new headphones that are supposed to be wireless. And they are only just now being finished processing at the processing place. So I'm not going to get those again until Wednesday. Can you believe that? 4 more minutes till more BS numbers. Can you imagine the number that has been sandbagged? Well, except for it's not sandbagging. It's what's the opposite of sandbagging? I don't know. But anyways, these numbers that they've been boosting all year and just got revised, and now we're going to use those numbers to determine whether we're going into a recession or not. I know it's wild, but guys, this non-farms is going to be nuts. It's going to be nuts. You've been warned. Okay, I'm going to go close the door. Close the door so that when the number comes out, I can yell and scream about it because we know that whatever number we're get that it's going to be. What? Okay. So let's keep the chair upright. So, the number that you're looking for here, the U.S. non-farms payroll headline number, previous reading 114K, forecast 165K, and I believe that the number is likely to come in slightly less than expected. But let's see. It's going to be a huge move. I'm going to keep my accounts disarmed for at least the first 5 minutes, and then we'll see where we go from there. There is a possibility that, like, even though this is a number that is good or bad, that, it's not, like, so far off of the consensus that, it really, really moves the market. But let's see. Even if it comes in, even if the number came in line, you're going to see a market that's just going to go like nuts. Yeah, Rodrigo, unemployment number. 30 seconds. Well, more like 20 seconds now. Somebody's placing their bets. Look at that. Hands off. 5 seconds. Ooh, I can feel the tension. This is going to be crazy. Okay. So I'm seeing the Treasury sell. And the S&P 500. Okay, so it is, wow. 142 versus 165. But the Treasuries are selling on that. Back to unchanged, down. Oh my. This is nutso. This is nutso. My data feed cut out there for a split second, couldn't handle it. Oh man, I have never seen volume come through back and forth so furiously like that in the Treasury market. So it was lower than expected, so I would think that would be a buy in the Treasuries, but they seem to be confused by that initial sell-off. Let's see here. U.S. average earnings month over month higher than expected spot 4 versus spot 3. That's not good. I was looking for, where's the unemployment rate? U.S. unemployment rate unchanged, or not unchanged, down spot 1%, but in line with expectations. Wow. Well, when I first saw that, I thought, okay, it's 140, which is like almost exactly on kind of what I thought it would be. And they sold. And so I thought, oh, well, maybe I should buy it. But, I said, no. This is going to be too crazy. Well, I think that if I had bought it with a live account, I think it might have stopped me out. How far did we move, though? We were up at 376, and now we are at 360. So we just moved 16 basis points? Are you kidding me? It doesn't look that big on the chart, but it is big. Oh, it is big. From the bottom to the top of this is almost a handle. Okay, but they are trading higher, and we're trading into some like key levels from way, way, way back. So now we are into this range over here. So the question here is this. The number was weak. Is it weak enough to justify a 50 basis point cut? That's the question. Oh, it looks like here we're not getting the audio. I didn't realize. Let's see here. Let me just restart the audio for a second. There we go. Can you hear the music now? Does it sound okay? Okay, good. All right, so my concern at the moment is I'm not sure that's bad enough for a 50 basis point cut. Okay, revisions reduced reported unemployment for June and July by 86,000. Jim Iurio, NFP numbers bad but not horrid, probably will price in 50, but the narrative will be returned to a neutral rate, says Jim. So yeah, I think he might be right. Like, that's kind of how I'm leaning, is like, in order for it to be a 25 basis point cut, the market would have to sell off considerably from here. So it is kind of pointing. I don't know. I still, even with that weak non-farms report, I really thought that it was going to be more. Not that I really thought. I actually no. I thought that it was going to be about 140. I spent so much time preparing myself for the super good and super bad scenario that I didn't really think through the neutral one. Because the issue that I continue to have in this market is that I don't think that the Federal Reserve needs to cut 50 basis points. But that's what the market is pricing right now. They're kind of halfway into pricing 50. So I don't know, but looking at the deltas, okay. So granted, when you get movement that furious, your signing the order flow is a little less reliable, okay? But the cumulative delta was not up. In fact, in the 10-year, if anything, it was a sell. So that does not give me a whole lot of confidence in, okay, this should continue to just move up because we're going to price in 50 basis points. Doesn't really scream that to me. I think that what's going to happen is we're going to, fall into the pocket here. So how far back, I don't know. Maybe this is as far as it goes. I think we're going to fall into the pocket. And should I call it the pocket? I don't know if that's a good something about that kind of rubs me the wrong way, but we're going to pull back, right? And then the larger term players will kind of come in a little bit later here, and we'll see if they decide to make a value play or what they do. Twos are being bid. Okay. Well, the cumulative deltas just turned around really quickly there. Not enough for me to be like, okay, it's on, let's buy it, but enough to get my attention. I was reading in the Discord there because somebody was complaining about there's I can't remember the name of the person that I think that they're talking about, but they kind of come in and once a week we'll have a conversation about that they don't think that Donald Trump should be president, essentially. And they're like, I think that they just come to troll people or something. But no, I think it's a long-time viewer. I would think that most of my audience is relatively conservative, but that I think that there should be things that liberals would really like, that conservatives would really like, and that liberals really hate and conservatives really hate. Like, the big thing is that I rely very heavily on empirical evidence, and the right's not so hot on empirical evidence. The right kind of thinks that everything that the establishment makes is kind of suspect anyways, and that they just make up numbers to support what they want to do anyways. They're not wrong. I mean, that is happening to some extent. It really is a thing. But empirical data is still a thing, and we can still do our own research and find empirical data and prove things. So right there, I think I kind of said some things that I don't think that there's going to be a single person out there that's like, I just agreed with everything Seth just said there. But I really think that we're in the most interesting time economically in history. Maybe that's why I'm here. Maybe that's why I've always had this unnatural drive to learn more about the markets and to want to be involved in the markets, and somehow got sent on this strange journey where I end up being a streamer and having a relatively successful YouTube channel, because we are learning more about economics in our day than the past thousands of years. Like, questions about the markets that people have been wondering for hundreds of years, we're answering now. Why are markets so volatile? We're answering that now. Is the market efficient? We're answering that now in like a real empirical, conclusive way. Why do so many of our economic models fail all the time? How come a lot of our economics aren't able to explain what the markets do or predict what the markets do? Well, complexity science is starting to answer those questions now too. And we're right there on the forefront. Nobody else is talking about this stuff, you know? Because governments won't leave them alone. Well, so when you think about the world of economics, one of the things that concerns me right now is that a lot of conservative people will say, this is all nonsense. I don't want to have any part of it. they're not going to want to go to university, or if they do go to university, they're not going to go and get an economics degree, and they're not going to stick around and do economics research. Basically, complexity science is a good explanation for why so many of our models have difficulty. We need people in there to start doing agent-based research, or agent model-based research is what I should call it, to discover these things. And so we want conservative people to be involved in doing those discoveries, and I'm worried that they won't be interested, But that complexity science, I hope at least, will provide really good answers to, what is the proper role of, or let's say the effective role of government in an economy. Be conservative or survive college with open viewpoints. I really think you can do it. Just don't go into gender studies or psychology, right? And rely on empirical data. So I think about these modern monetary theorists, guys, right? Because it seems to me that they actually do have one thing correct, which is if the government is doing a lot of government spending and putting a lot of money into the economy, that's going to tend to create inflation. But if you take money out on the other side with taxes, then that should prevent hyperinflation from happening. There's going to be counter moves to that, though. There's going to be things like the bonds move and the currencies move. And I don't know if I can completely accurately predict what those are going to do in all circumstances, but those are things that could kind of put a kibosh on that whole plan. But I think the bigger thing is this, is like, remember our analogy where it said, like, think of the money supply as like a big water tower or something, and you've got a bunch of these faucets dumping water into that holding container, and then you've got a bunch of outlets letting water come out. Well, what would happen if all of a sudden you just created this huge faucet that's like 50% the size of that holding container? And so then you have to go and open a similarly sized hole on the bottom of the container. You might as well not have a container at that point, right? It's basically, it becomes a pipe, right? That is modern monetary theory. That's what modern monetary theory would do. And so what would be the result of that? Nobody would be able to hold on to capital long enough to do anything productive with it. So you would maybe potentially avoid hyperinflation, but people would not be happy. People would not be building wealth, and the economy would be extremely unproductive, right? You'd have like this absolutely insane velocity of money and GDP growth like going nowhere because nobody's doing anything productive with that money. It's just the government's giving that money to its cronies. Those cronies spend it as quickly as possible before it gets taxed back out of the system. That's what would happen. Right? So we need people understanding this stuff. And we need a wide variety of people understanding this stuff that come from different backgrounds, especially conservative backgrounds. Like, well, yeah, even the Marxists. So there are some economic departments in universities where there are professors and so forth that are basically Marxists, yes. Oh, I don't think it's as bad as y'all make it out to be. You have to, you know, listen. If it's like a video game, right? You find opposition, that means you're going the right direction. Yeah, there's going to be some battles here. There's already a battle, right? There are people do not want to hear these answers that we're getting about the markets. Again, we're answering some of the greatest questions in economics that people have wondered for hundreds of years. And people are kind of don't want to hear it. They're ignoring it. They don't want to hear that the market is not efficient because that's what they've been told for the last like 50 years or whatever. They're going to fight against it. But we have empirical data on our side. Like eventually, and when you have empirical data, you're going to make decisions, you're going to do things, and they're going to work. And eventually you're going to win out simply because you're effective, and they're not. Because they're going based off of some ideological idea of, trying to create fairness in an economy and all the other BS that drives Marxism. You're going to beat them. You're going to beat their pants off. It'll be hard. People are going to fight you, but you're going to win. There's absolutely no question what's going to win. Like think of it from that perspective, right? Like, you go and you do the empirical research, you know what the reality is, and they don't. So it doesn't matter what they do. So they can't change it. You're going to win. Like this whole thing with like Donald Trump becoming president and yada, 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 it was inevitable that a person like him would win. Why? Because the establishment has kind of camped out and set itself on this pedestal that has a weak foundation that doesn't actually work. So it was always inevitable that somebody would come along and just push them off because they would be effective doing things that are effective. It was inevitable. I mean, if it wasn't Donald Trump, it'd be somebody else. Somebody else would eventually see the opportunity and take it. Hey, Eric Wallerstein, this was a weaker payroll report than we expected. Encouragingly, household employment aligned with our expectations after the material weakness in July was temporary. 10-year shrinking, and the Fed will cut by 25 basis points. He thinks that the Fed will cut by 25 basis points. So I guess one thing that I should note here in this situation is that I do think that the 10-year is a little bit rich if we're going to do a 25 basis point cut. In other words, like maybe the treasuries do have to sell off, but you're going to see that flow more in the bills than you are in the treasuries. So look at SOFRs, euro dollar, and they're even still around. Maybe the 2-year. That's where that flow is going to be the strongest. But when I look at the chart here, man, look at that delta. The delta is turning hard. So like I think that the market was hedging itself and so forth, expecting a weak number. They got the weak number that they wanted. And now that event has passed and all of the flow based on the knee-jerk reaction of that thing has come through, now they're looking at the absolute numbers and they're saying, oh, this is actually too high, and maybe we won't actually get a 50 basis point cut despite the weaker payroll report. And so we're selling back to the open. In fact, the seller cost base is just below us at 29. So I don't want to speak too soon. I don't know if this is a gamble I could take. This is a gamble I could take that they continue to sell throughout the session. But I think it's going to be a pretty volatile one. I don't know if that's one that I really feel confident about being able to hold on to. It's a lose-lose for Powell. Maybe. I mean, I think that if the I think that where the economy is right now, that you know, the whole concern here is that the economy is way weaker than we think, right? And that if we don't do anything now, or that we should have done something back in July to prevent the economy from going into recession. But at the moment, the impression that I'm getting is that we're not quite so on the edge, that, you know, like, we're just really going to fall over. I think that we're standing on the edge and we're looking over, but, you know, we still have some flexibility. So, like, let's say that the underlying economic conditions and the future economic conditions that we can't really know perfectly do justify more aggressive rate cutting. And we only do a 25 basis point cut. That's not necessarily a fatal mistake, I think. It would be a mistake. It would maybe be a policy mistake, but maybe not a fatal one. But I don't know. That's kind of been the whole narrative for the past few years, hasn't it? Was the policy mistakes that we made before COVID and after COVID, were those fatal policy mistakes? I don't know. It's kind of hard to really know. I got this little knot in my cord here. It's driving me crazy. Yes, the downward revisions to June and July were down 86,000. That's why they're giving us the Lions winning the Super Bowl story. Oh, is that? I haven't kept track of football. I'm gonna try the hockey thing, man. I've been preparing myself for hockey. Every day I'll go and I will watch a video about hockey to try and learn more about it. Like, I know what icing is. I have a bit of an idea about who the teams are and who's good and who's not, and some of the drama that's been going on. I understand the makeup of the teams and stuff now. I have a new television to watch it on. Like, I'm gonna try the hockey thing. So if they come in and they start inserting BS into hockey, I don't trust them Canadians. You know, Trudeau and all that. I'm trying with the hockey thing. I tried with football, and it was like, as soon as I tried with football, then they started doing stupid things, and I'm like, I'm not interested. Plus, they made it really hard to watch in my area, so that also didn't really work out. Basketball, they did that. You know, basketball, it's kind of calmed down, but my basketball team, like, really sucks right now, too, so... Okay, so we are getting a bounce now after that decline back to break even. So this kind of a pattern is not very common, but it is common during really high level, really, really important news events like this, where you will have like a head fake the wrong way, a push, a return back, and then a move to where it's supposed to go. We still don't know where it's supposed to go. It could still be up or down, but it's entirely possible that they go from here and they go and they bust those highs. That's well within the realm of possibility, okay? Hockey is fun because it is a fast game. Yeah, well, so last night I got the Switch out because it had, in the settings, it had like this game optimizer thing, which I think is kind of weird, but like, and maybe unnecessary, but you can go and you can say like, what is the genre of your game and all of that sort of stuff, so that you can like, because they're OLED, so you can like optimize between a really fast pixel response and it looking really bright and vibrant, I guess. And like when I was playing Tetris, I could immediately tell that the input latency was less. The input latency was basically zero. The game was reacting to me as soon as I pushed the button. And like I can read text so much more clearly on that screen. Before, it was like anytime I was playing a game, I had to like get up out of my chair to be able to read things. So I'm hoping that will help in watching hockey. It also, you know, the thing that I notice about hockey is that they kind of have this approach that is kind of more like, let people do what they're going to do. And if people are going to F around, they're going to find out. And it kind of self-polices. Like, that's the whole thing with allowing fights in hockey, is because you can hit people. I mean, like tackling and all of those sorts of things, there are rules around it, but you can be really rough in hockey, and that can get out of control really, really easily. And how do they prevent that from getting out of control? Because with the officials, you know, it's like they're not looking the right way or whatever, you know, and it just gets ignored. That's the way that it goes in other sports. But in hockey, you beat them up. And people don't want to do dirty things because they don't want to get beaten up. That's really interesting to me. It's really, really interesting to me. Okay, so we got a little bit of a bounce. I just saw another counterflow come in, and now it seems to be resting. So we may just develop a volume area here. With hockey, it's not about money. They don't put much emphasis on players like they do in football. Well, so this is an interesting thing about hockey, is that it is so intense. It is so intense. You can't be out on the ice for like 10, 20 minutes at a time. You're going to like go out and skate for a few minutes, and then you're going to come in and take rests. So they have, typically for offense, they have 3 lines. So there's like, you get 3 forwards and 2 defensemen, and then you've got usually 3 or 4 forward lines and like 2 or 3, and I don't remember the exact number, but 2 or 3 defensive lines. And then those, they switch off, right? And so, yeah, the effect that any one individual player has is less because they spend less time on the ice. There's more equal distribution of time amongst the players. So that's kind of interesting, yeah. like rugby, no pussy pads and helmets. You've seen these weird new helmets that they're allowing them to use in the NFL? It's kind of weird. But they did need the pads. It's getting better because like the padding is becoming more compact and better and everything. But football is a really interesting thing too. Like, so the thing that I find interesting about football is that having these special teams and like lining things up for a play every time seems to be a little bit more like the way that actual wars would play out. Is that you wouldn't, everybody thinks that it's like you got these two armies and they clash into each other, and then from that point on you're just kind of hacking and slashing for hours at a time. Like, no, you can't do that. You can't even do that for more than like 5 minutes. So what's going to happen is it's, like in hockey, you line up and you're going to clash, and then people are going to come back, and different group comes in and clashes, and it's constantly people coming in and out. And football kind of emphasizes that part, and so it creates this also like really strategic game that is played on it. So that I find incredibly interesting. It's just that, like, I didn't like the way that the NFL was taking things. They were inserting a lot of politics on things, and they were also kind of like with their content. They were doing things with their content that I didn't like, and so it was like, ugh. Like, in order to really enjoy and follow this, you've really got to have, like you've got to pay for the streaming plan or whatever. Probably have to be involved in sports betting, all of these other things. It's like, no thanks. And then I have a local team, but this year we have a local team, so we're gonna try it. Okay, they touched the open. Oh, not quite. No volume went off at 27.5. So the price that I was thinking about was 3.7, but remember I said no. So I think it went back all the way to 369, and now we're at 3,710. So I guess if I had held on, I would be able to get a winner off of it. Now the issue is, how much chop are we going to get at 71? 371. If you're talking about fun sports that are still good today, sumo. Oh, where do you watch sumo wrestling at? It's been a weird week for me, man. I should have been so much more productive. I spent most of it searching for the car keys, man. I still haven't found my car keys. My wife got this thing that is supposedly going to allow us to like program our own key, but like I haven't found the original key. I don't know if I ever will. You can sneak it on YouTube, but NHK loves to take it down lightning speed. I'm in a Discord that provides alternative link. But is there like a streaming service that you can get that just gives it to you? Because I'm willing to pay like $10 or $20 a month for something like that, if I get good content from it. Nope, the Japanese don't let us have it. That's funny. I would assume that things like that would be like pay-per-view, right? Okay, so once we kind of more conclusively passed the open, another little wave of selling came through, especially in the 5-year. Like, look at that. I was at 710 and I was like, how much? But they're at 725 now. Man, so fast. That really makes me FOMO. I'm absolutely feeling the FOMO right now. But I just have to remind myself, okay, it just went in the course of less than 5 minutes. It just went 2.5 basis points. It can just as easily go the other way. Do you really want to risk 2.5 basis points today? I'm thinking no, not unless I'm really positive. And I don't know if I'm really positive. This is still a little iffy. It's iffy. Because it's kind of like, it was weak. It's not doing what we thought it would do when it was weak, but we kind of predicted that it would not do what it's going to do when it was weak because of valuation levels, which is kind of a questionable flow to base a trade on, you know? I'm watching my TLT position go nuts in the pre-market, I bet. The moment it kind of looks, though, like it's going to go down. I was thinking about you last night when I was like doing my preparation for the non-farms, because I was like, you know, if we really do go into a recession, Uzi's going to be in a pretty nice spot. Like, that's the whole risk with the kind of a portfolio like that, right? Is that if we get past all of this, we have a soft landing. Like the scenario here is we do get some economic weakness, but they normalize interest rates. Donald Trump wins the election and he doesn't do anything stupid like impose an across-the-board tariff, okay? And then the economy could probably be in a really, really good spot. And you could, you know, have another one of these time periods where you double and triple your money and all that sort of a thing by staying in the markets. Versus, we have a small recession. You're going to make 40-50% on your bonds, your treasury holdings, and then you should be able to switch around and buy the dip. I mean, that's pretty big too. So it's wildly divergent way of going, you know? But if the recession scenario does happen, it sure seems like you've positioned yourself well. Because you're basically got a position that's like, even if it doesn't happen, you're probably not going to lose money on it, you know? So that's what's impressive about it. It's always like the easiest thing is to have a position, you know, at the beginning of a trend, and then it turns into a real trend, and then you just let it ride, right? Let it ride. Let it ride. Meanwhile, I'm sitting here and I'm like, I need to allocate more money, but I don't know where to put it. You know? Okay, let's see here. Nick Timrose, 25 seconds ago, John Williams' prepared remarks don't make any effort to lay the groundwork for a 50 basis point cut. Williams says policy can be moved to a more neutral setting over time. He's doing Q&A now, and if the person asking questions decides to ask about monetary policy instead of, instead of treasury debt management, maybe we will learn more. Okay, so I guess that means that some of that move may have been because of Williams, but that means that we are still at strong risk of volatility. Because he could say, actually, I am leaning towards a 25 basis point cut right now. And then this thing would just skyrocket out of here, right? The market is now pricing in that the Fed will cut interest rates by 125 basis points to 4 to 4.25 by the end of the year. Really? That's what the bond. That's what the bills are pricing right now, huh? Yeah, that is not a soft. You're right, Anthony. That is not a soft landing stance. Octavius, no way. Yeah, I like here again. This is where I say we think that the market is efficient. We think that the current price is reflective of all available information, and so we go with this theory that okay, that means that the market thinks that the Federal Reserve is going to cut 125 basis points. That's not what that means. I mean, that is like the equivalent current valuation, but that doesn't necessarily mean that that's what the market thinks, because there's all of these other reasons why people have bought and sold it, right? There's been all of these little interim things along the way that has pushed it and so forth. Now, at some point, maybe you have a situation where the valuation is so far out of whack that people come in and and we start to get orders just based on the valuation. But that's like one of the last flows that tends to come out. So, and that's just kind of the thing that I've been saying this whole time, is that like current valuation does not seem to reflect the actual economic situation. So prices are inefficient. That doesn't mean that we should take a short based on it coming back into line. But if we have reason to believe that we're going to start to see that flow come in, we can take it. And you probably make good trades on the downside. But I think that 125 basis points is a little bit too much. Yeah, because let's see here. We only have like three more meetings this year, right? Well, let's go check. September, November, and December. So based on my own current thinking on the market, which may be just completely wrong, they should be pricing in 75 basis points to 100 basis points. So 125 is too much. You say 25 to 50 cut, no difference. This market is too invested in emotion and hysteria of all the headlines plus an election. Yeah. Well, so the election is a really good point. That like they're probably trading things more based on the election than they are what the bond rate is going to be, for sure. I mean, when it comes to the S&P 500, that's absolutely the case. But I also think it's the case here in the treasuries. I mean, basically, you've got this whole thing this week, and frankly, you know, some of this stuff down in here as well, that, you know, was just like all up, and I don't think is necessarily a reflection of the actual state of the economy. It's kind of an overreaction. Like this right here, especially. Not that I was shorting it or anything, but when this happened, I was kind of like, this is a little bit too much. There's no way that that's going to stay. But you'll note. You come out to these, like really, really wide. The treasury market is really kind of like, does this zip, 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 zip. Like it really will swing. It will really overdo it and come back. Like the S&P 500 is kind of more like. Here, actually, let's switch to the chart of the ES, right? The S&P 500 moves are a little bit more. Well, that one's like that. It's actually kind of like the opposite. There's like, oh, crash. Oh, it's okay. But, that's only when there's like a risk headline out there. But generally speaking, you get these pretty good distributions, good variance. That's what I call it. So basically the treasuries do like overdo it when they do it. Like I think that was like the first thing that kind of set me on this path towards, because I read all of this empirical data, and the conclusion is markets are not efficient. I'm saying most people are not accepting that. Like there are like big people in the academic community that don't want to believe that. Part of it is because they're looking at a different thing. Really, all they care about is, should I invest in an index fund or not? This is really all they care about. And they say, well, you should invest in an index fund, ergo the market is efficient because you can't beat it, right? I'm looking at it from a different perspective. Well, first of all, I'm looking at it from the empirical perspective, but I'm also looking at it from the perspective of, okay, so if the market is inefficient, where are we feeling that? So why was it that I was able to accept that empirical data when a lot of people haven't? Well, I think one of the first things that kind of keyed me into that was knowing that the treasuries are probably the smartest instrument around. Like the big guys that trade the treasuries, those are like the most skilled practitioners, the most knowledgeable about what's going on. And yet I still see the bond market do absolutely stupid things. They're the smartest market, the first to react, and yet they completely overdo it every time. Like, especially after COVID there. So I remember all these people saying, like, they're not going to raise interest rates. They can't raise interest rates. Like, the debt would be too much, and they can't do it. They did it. And the bond market was slow to realize it. Very slow to realize it. That's kind of where I came down into this spot. Now what I see is, okay, I'm not the only person out there that understands that the market is inefficient. But what has happened is that most of these people that realize that the market is inefficient are liberal and have used that inefficiency to basically impose a liberal ideology on everybody. Hence, diversity, inclusion, equity initiatives, and all of this other nonsense that we've been seeing. It's so absolutely infuriating to me that it's like you come in and you say, okay, the market's not perfectly efficient. I have some opportunities because I have a lot of power in the market to come in and do things and make decisions based not on what I think the market is going to do, because the market is always right, but based on what I think would be best for society at large. And they don't come in and say, well, we should prioritize longevity in front of short-term profits. They don't come in and they say, we need to treat our employees like real people. They don't come in and say, let's have quality products that last. None of that stuff. That would cut into the profits. No, we're going to do all of this patronizing BS instead. It makes me angry. That's the way that they took it. That's why what I want to tell people is, yeah, the market is inefficient. And that means that the decisions that you make matter, and that we have to make decisions based on what we think is best and not necessarily what we think the market is going to do. And we need more people involved in making those decisions. We shouldn't be giving all of that to Larry Fink. I don't have anything personal against him, but I disagree with where he's taken things. Right? We need other people involved in this. How do I convince conservatives that this is what they need to do? Right? But you're all so that I've been there. Conservatives. I've been there, okay? Because I thought Mitt Romney was a conservative, and I thought that he was going to be effective and all of these things, and then he just like fell flat when he ran for president. And then after he ran for president, when Donald Trump kind of adopted his platform, he started trashing his platform. Right? The reality is politicians don't do jack squat. You really actually want to have influence in this society, you need to invest. You need to be involved in investing and developing innovations and things like that. That's our responsibility. And that doesn't mean put it all in an index fund. Okay? Do that with your retirement. You should. Because, I mean, that's going to get you the best risk-adjusted return over time, is investing the index fund. So all of that money that you're putting into your 401k, even the money that you're putting into your IRA, because you should probably be putting money into your IRA, especially if you have kids, and because you're going to have to pay for their school. But then you should be investing money outside of that, if you can. And when you do, buy individual companies. Buy companies that you like. That you like what they're doing and you believe in and you're interested in following. That it's not a chore to go and read all of the details and press releases about what that company is doing, because you are invested and you are interested in that company and you're excited about what they're trying to do. And only have like 5, because you can only keep track of 5. This is ridiculous, this idea that like you're going to have a company like BlackRock and they're going to own 500 different companies and they're going to effectively manage and help make all of the decisions for those 500 companies. No, they're not. You can't keep track of that much stuff. And they don't care, because any one individual company is only so much of their, the rest of the index will make it up. So it doesn't matter if they make a mistake. You got to be actually invested. And we need more people to do that. We need more. If you want, there are problems with our society. If you want the society to start going in that direction, that's what we have to do. The politicians aren't going to do it for you. You have to do it yourself. And that means investing. You need to be involved with the BS as an investor. Yeah. Well, there is, like one of the big issues here is that a lot of the problems that companies have are caused by essentially everybody abdicating their responsibility to, actually do their job as investors, look at issues and decide what is going to be best for the company and what is going to be best for the society at large, and vote with your money and, buy the stocks that you think are doing things that are good, and, voting at the shareholder meetings and all of that. And instead the market will handle it. They haven't handled it. All of the problems, all of the things that people are complaining about today, whether you're a liberal or a conservative, they all come back to this kind of giving that responsibility to somebody else and letting them doing it, and then complaining when they make a decision that you don't like, and hoping that the politician is going to fix it for you. Well, that's weird that it blocked a Spotify. I've got a chest full of regrets with day trading, and I have only one with investing, and that's that I didn't start sooner. You know what I really want to do? Is I really want... sorry, what is his name? Icon? What's his first name, though? Carl Icahn. Yeah. Uzi beat me to it. Carl, I really want to interview Carl Icahn because I want to know how he makes his decisions. How does he say, this is a company that I want to get involved in and be an activist investor in? And like, how does he approach doing all of those things? Because essentially part of what I'm saying is that individual people should be more involved in that kind of world. And so what does Carl know that can be applied to general people? Hold on a second, wives. It was not the wife, it was my daughter. Hold on a second, it's not connecting. So when I was writing last weekend, or I guess it was Monday, when I was writing on Monday and I was going through this and I was kind of like, Seth, you're running out of time. Like, you should be interviewing guys like Carl Icahn. And like, he's old. So like, the time to do that sort of thing is kind of, declining. Maybe I should just send them an email right now. I kind of feel like if I sent them an email right now that they would kind of be like, nah. But maybe I can pull it off. Maybe I should just try. There's some other people that I need to interview too that I think I could. But I just, it kind of cemented in my mind. Okay, you know what you're supposed to do. You've kind of been biding your time. You need to be getting more into it. You've laid the framework, like we have all of the base information to know what's going on and what we need to do. We need to start doing it now. Well, about 20 minutes ago, that low that was set 20 minutes ago, the cumulative delta in ZN has been basically flat since then. So yeah, and there was, okay, what is it with Spotify? I keep getting those blocked. It must be from Spotify. There it is. I'm like, where even is the control center for it? Oh. Security update, device restart recommended. I see what they're saying now. Like, so it's the internet protection, but like they don't really get a whole lot of... Let's try that. Is ESET a good antivirus? In my opinion, it's the best. So what kind of makes ESET special is, well, first of all, I mean, it's serious. It's a paid program, and they don't have any of this BS that like Norton and all these other big name antivirus names from the 90s were doing. And they're really focused on like efficient processing. So like the people always look at how much memory does it use up, but that's not actually what you want to look at. You want to see like how fast is it at doing what it's doing, and how much is it actually disrupting the rest of my computer. They actually use a little bit more memory so that those processing things can be faster. So it's very transparent. You never notice that it's there. They like in all of the tests that people do, and of course it's always a changing thing, but they do consistently well on tests that they are picking up the new viruses and getting the updates out to you as quickly as possible and things like that. So it's a really good antivirus, and as far as antivirus goes, the price is very reasonable. TLT opened unchanged. All that squiggly for nothing. I have to say, for a non-farms payroll that we really talked up, right? I think that it was justified to talk it up. I think that it is, that it was as important as I thought it was, but what it's doing is not what I necessarily would have predicted before the news. Like I was so focused on the scenario where it's like it's gonna be a recession, or like, oh, it's still too hot, and we would see a huge move based off of that. And instead, what we got was, oh, it is weak, but not that weak, and then they sold off because of that is a little too interesting. I would not have been what I predicted. And I still can't say where it's going to go. Can you believe if I had taken that trade that I had considered, but I said, nah, it's too volatile, I'd be up $40? That's nuts. And like, it doesn't look like they're anywhere even close to done either. But there's still the problem is it's still doing like 2 basis point swings. So like to play, I would have to risk $20. I don't really especially like right now, because we just saw another kind of like plunge lower, but I'm not seeing the cumulative delta in the 10-year follow along with it. We are seeing the dollar get stronger here, though. Like I'm really seeing some really strong movement in the dollar. Right now, the dollar's moving really big. Oil seems to be moving really big. The treasuries did move very big, but I'm just not seeing the volume in it. Oh, yes, and I almost forgot. Another thing that's keeping me out is that we have a Fed speaker right now. So he was doing a Q&A, still saying things. So, like, the thing about Carl Icahn is that from what I've seen, and I've done some searching, but maybe I need to search harder. He doesn't have like any books or anything like that. If he had a book, I would just read the book and... It's a pretty big order following him down at 20 half. It's a little nerve-wracking to me. Well, are they gonna test him? Okay. So 6-3 is traded there. It didn't pull. I'm going to put a Sims stop there. Because like they tested it, and now they kind of look like a little bit reluctant to try and clear it. So if it does fail there, maybe it is like we're set for the next kind of rung. Okay, they cleared it. Actually, not that much to clear it. So... They might cough and destroy the... It's like they didn't go. It was a spoof turn point today. Yesterday, that exact setup resulted in like a washout. But I didn't notice Carl himself has not posted on Twitter in almost a year. Oh, no, wait, I take that back. He did something on August 19th. But then before that, it wasn't until December. Oh, that's right, because there's that whole thing about the Hindenburg report. Oh, I forgot about that. Okay, they're coming back down there now. Oh, I shouldn't have canceled that order, huh? What price was it at? Oh, I forgot. I have a meeting this morning that I really need to pay attention to. So I'll probably turn the camera and the microphone off for that, because there's a meeting that I really wanted to do this morning. So, in fact, I will turn that on now. Okay, anyways, orders. The stop was at 19.5. Yeah, would have been good. Probably too late now. Random question. Do you think there's a currency that could have a similar economic impact like the Japanese yen shift had when they raised rates, or was it a unique situation? Oh, that's interesting question. So the kind of shift that we had with the Japanese yen in the United States, probably not. Which is to say that like nothing super crazy happened, but it still had like a really outsized effect on the market, right? If something happened in Europe, like like the Greek debt situation, the things happening with the euro, that could have an outsized impact on markets. But that's like, you're talking about like an outright panic situation versus like, a little bit of a change here on the interest rate over in the Japanese yen causes the S&P 500 to decline like, almost 10% over a month, over the course of a few weeks, right? So probably not. And especially for the United States and the treasuries, because most of the treasuries are bought up by Japan, right? So it's pretty, it's a interesting and crazy setup. You're having the best day of the year. I probably shouldn't be so risk adverse. I'd be up $40, I think. And here I am, I'm still scared to touch it. Right. Well, no, I'm not going to touch it now because I got a meeting, but it's okay. If I'm kind of like in line with the flows, like, okay, I kind of think that they might be selling off here. Overall, they might sell off, even though the number was weak. And I don't trade it, but I'm correct, then I'm still happy, because that means that like if I am in line when I do decide to take risk, better chance of something good actually happening from it. And I did, I wanted to take that 19.5 and it bounced, and so I took the stop out, and then it immediately came back down, so that's pretty crazy. So now we're at almost to the 16. Well, I tell you what, if they get to like that 10, if they get to 10 before we're done here today, that's going to be bonkers. Like, I think that you could see some really angry flows if they get below 10. At the moment, though, I'm still not seeing like outright selling in ZN. I am in ZF and probably ZT if I had it up, but I am not getting it in ZN at all. So that also does not, like the last almost 40 minutes now, have been in an area where I can't really take a live trade. Like it does not, the deltas are not in line enough for the kind of trade that I want to take. Let's see here. It's just that rate futures traders reverse earlier bets. Now see 25 basis point Fed cut September, more likely than 50 basis. Yeah. Like what I'm seeing here is we were buying the treasuries not because they were betting on a 50 basis point cut, but because they were hedging and making, decisions on individual moves. And now that we've had that last data point and people are actually going to go in and take bets on whether it's going to be 25 or 50, I think that they're betting that it's going to be 25. Seems to me like it's going to be 25. I just don't. It was a weak number, but it was kind of like a good weak number. Like it was just weak enough to be good. I don't see them cutting 50 basis points for that. I just don't. Because the issue that you have there is like, maybe you could get away with 50. I think you could probably get away with 50. I think you could probably get away with a 0. Like, it would be a mistake, but it wouldn't be like a fatal mistake. Right? If the reality is that 50 was too much, or like maybe we shouldn't be cutting at all, like inflation's going to come back, well, wouldn't it be better to gradually lower the rate so that we can kind of see how the economy's reacting to it? Instead of like doing 50 all at once. And then I think that you'll really only do that if you really think that we're falling into a recession. And it doesn't seem to me that the market or anybody on the Federal Reserve Committee thinks that that's going to happen. Ergo, I say 25 basis points. So all of this other stuff is just remember, like markets try to price things in, but they're not very good at it. They're very inefficient. And there's lots of factors that have been involved that have pushed price very far away from where it really probably should be. And it really probably should be treasuries a little bit lower than here. Like rates should probably be, I'm not going to say like outright 4%, but they should be closer to 4%. I think there was some guys out there betting that we would go back to 4%. I don't think that we're doing that. But, in the mid 80s, yeah. Which would probably take us back to, like maybe the lower end of this range. Maybe a little bit lower. Maybe 112. Let's say 113 even. 113 even. And then reassess if we get there. is kind of interesting. Okay, so like right there as an example, you just saw 17 half go bid, and it was pretty quickly that they were able to put up 2,000 contracts and be more than the offer. Okay, well, it didn't do it that time, but when that ticked up, you could see all of the orders on both sides kind of shuffle around. Like they viewed that uptick as, oh, okay, maybe I don't want to provide as much liquidity there because it looks like it's coming back up. Octavius, I can't remember the last time there was such a whipsaw off a number like we had today. Not like this. I can certainly remember times where we had a non-farms payroll and we moved big. And even times where we moved bigger than we've moved today. I can also remember times where we have whipsawed. Like it went one way and then it went complete extreme the other way and then it came back down the other side and whatnot. Okay, but off of that particular like change in news, you know, like a relatively mild miss. Not off of such a mild miss, no. Granted, we are in like a key decision point, so I think that kind of explains why. But it is certainly not the way that I think we all expected this to play out, is it? I think I was expecting that the number would come out and they would decide whether it was good or bad, and there would be like this huge wild trend for like 5 minutes, and then they would kind of start to consolidate on what they thought about it, right? Because that's just not what it did.
Block buy.
Okay, there are some big bids coming out after that few ticks up. 5Ks showing up all of a sudden in the 18, 17, and 16. You're not seeing offers even close to that. The biggest offer I've got is 46.94 all the way up at 115 even. Yeah, and there was that block buy alert as well. 3,000 at 18.5. That's a really odd shift. Okay, guys, I'm going to turn the camera and everything off for a little bit, but I will be back before the end of the stream. Okay, guys, we're back. That was a really good meeting. Was quite successful, I thought. While I was gone, my goodness. You know what? Like earlier, I was feeling like some major FOMO, and now, but I said no. I know that I shouldn't trade this, and now here, 30 minutes later, I can see, I remember now why I'm not supposed to trade these. Look at that in the treasury. All the way down, all the way back up. The cumulative delta has been flat throughout that whole thing. Actually, well, I mean a little bit of buying in the 5-year, more aggressive buying in the 30-year. A little bit of flattening in the yield curve, so maybe some of it was due to the yield curve, but it seems to me that the biggest driver here has been, coming back over to my other screen here, the dollar right next to my face down on the bottom. You can see here that when the dollar kind of topped off and started heading back down was when the treasuries started to recover. So the treasuries are retracing that down move as the dollar retraces. So, and again, I was looking at it like we were up $40 or $50 based on a theoretical trade at 3.7, and we're back to 3.7, and it would actually be underwater 10 ticks now. So I'm happy. Like I was able to predict at least some of the flows here today, but I also was able to use my experience to keep me out of trades that I knew I didn't really have a very good hit rate on. I think it always sounds kind of a little bit weird to say, oh, well, I didn't take any trades today, so that makes today a success. But I think that here today in particular, that it was a success not touching it. And that also, again, we were saying, okay, we've seen bigger moves, we've seen bigger whipsaws, but a whipsaw off of like that small of a miss is pretty wild. And now you're getting to, man, that amount of whipsaw is just really jarring. Okay, so now I'm getting comments from Waller. I guess that was his speech that's coming up in 30 minutes. And that also, though, does not really sound to me like that you're going to get 50 basis points. Let's hear. What does Forex Live here say 16 minutes ago? Bond bulls not ready to throw in the towel on 50 basis points. Waller coming up at the top of the hour. But the comments that we've gotten from him do not scream 50 basis points. Like this is the issue that I'm starting to see. And maybe, do we have Fed speakers next week? Let's come in here. Let's come to Forex Factory. Let's change the filter here to be only central bank. Only U.S. central bank. Apply filter. And then do next week. Federal budget balance. Oh, no, wait. Is it a different filter? Is there a speeches? There we go. That's what we want. So there was Williams and Waller, but then, are we in the blackout period? Hold on, I must be. I might be stupid here. Yeah, it's on the 18th. Yeah. Oh, that's They've been in the blackout period. Okay, so this Friday, today rather, is the beginning of the blackout period. After today, they are in the blackout period. So the blackout period, the meeting is on the 18th, and the blackout period starts the Saturday before that, essentially. So like here's that the week of, and then the week before, and then that's when the blackout. So these speeches from these guys is the last comment that we're going to get before we have that meeting. And you got this non-farms. They've got the non-farms. They should be speaking and giving us an idea about what they think. And they're not really saying anything that makes me think that it's going to be 50 basis points. So I think that the default assumption that you have to have is that it will be 25, unless they give us a hint that something has changed. Now, do we have, so coming back here, apply filter, okay. Next week, we do have CPI and PPI. So those are pretty important as well, but I don't expect to see, like, the estimates are coming in at spot 2 for everything for those ones. So as long as there's not, like, some huge outperformance on those and you get, like, a spot 4, spot 5, those probably aren't going to change it. So I do think it should be a sell in the treasuries that they're only going to do a 50 basis point. But it looks like there are some guys out there that aren't giving in on it yet. So this is one of those trades. This is the most frustrating kind of trade that I've had, when it seems very clear to me that a certain thing is going to happen and the valuation needs to change because of it. But there are some people that are really dedicated to that trade and they're not giving up on it. So very often the case that, you know, as an example, the one that I always think back on when this happened was when the trade war with China ended. Basically, you know, Trump and China came to some sort of ceasefire agreement, you know, anticipating that they would do that until the election, and then if Trump won, then he would continue his trade war, right? And when that happened, there was all of these people saying, oh, the deal's not real, or all of these things, like taking a counter trade. And so that day, it was like there was the big move, and then it like completely retraced, and we didn't make any money on it. And then over the weekend, it went to where it was supposed to go. So you might be getting that sort of a thing play out right now. Let's see here. Mohammed A. El Arian, especially after the excitement of a month ago when analysts and economists suddenly jacked up the probability of an economic recession. This morning's August jobs report comes as a relief. That is, unless you're absolutely convinced that the Federal Reserve would cut by 50 basis points in just under 2 weeks. The report points to a labor market that, while weakening over time, is staying robust enough to avoid the dynamics that suddenly pull the rug out from under the economy. This is also why the Fed is likely to cut by 25 basis points rather than 50 basis points. 2 additional notes. The half-empty camp will highlight the downward revisions to the June and July estimates as indicative of the labor market weakness that extends beyond what the August numbers suggest. The report is consistent with my long-standing view that there is a 50% chance of a soft landing, a 35% of a recession, and a 15% of a bigger but not hotter economy. Okay, I generally agree with him. So it's both comforting and disconcerting when my own intuition about what these things mean aligns too much with the major market analysts out there. But it is what it is. Let's go over to Zero Hedge and see what they've got here on the miss. Okay. There was some good news and some bad news in today's jobs report. First, the bad news. The August payrolls number came in at 142,000, a small miss to estimates of a 165K print. If a big jump from the downward revised July print of 89,000, the good news, however, is that while the payrolls print missed, the unemployment rate actually dipped from that critical SOMS rule trigger level of 4.3% to 4.2%, in line with expectations. So bottom line, the number could be better, but it is certainly not bad enough to trigger a 50 basis point cut in 2 weeks. Here are the details. As noted, in August, the U.S. added 142,000 jobs, which was slightly below estimates of 165, hardly some crazy outlier as in previous months. And that is kind of the other thing, is that I was really expecting a big out, because that's just the way that it's been coming in so much. Then again, as has become the norm, both previous months were revised lower, so once again expect August to suffer the same fate. Specifically, the BLS said that the payroll print for June was revised down by 61,000 from 179 to 118, and the change for July was revised down by 25,000 from 114 to 89. And with these revisions, employment in June and July combined is 86,000 lower than previously reported. It also means that 4 consecutive job prints have been revised lower, and 6 of the last 7. Looking at the components, while most sectors tracked by the establishment survey posted an increase, the all-important manufacturing sector lost 24,000 jobs, of the second worst month for the sector in 3 years. And while the establishment survey was disappointing, the household survey was, for once, rather strong, showing a 168,000 increase in employed workers. And since the number of employed workers declined modestly from 7.163 million to 7.115 million, the all-important unemployment rate also dropped, which, as we noted last month, was the critical SOM roll trigger, which, according to most, means that the Fed will only cut 25 basis points in 2 weeks. Among the major worker groups, the black unemployment rate dropped to 6.1% in August from 6.3%, and while the white jobless rate held at 3.8%. I don't want to go too deep into some of these things. Let's see here. The individuals were not counted as unemployed because they were not actively looking for a job during the 4 weeks. Blah, 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 blah. This economy is not slowing down in the way markets are anticipating, says Chief Economist Torsten Slok at Apollo. We will not get 8 cuts over the next 12 months. Of course, much of this is purely optics, as we will detail shortly. It was all thanks to a surge in part-time workers and illegal immigrants. Taking a closer look at the actual jobs, the BLS reported that employment growth in August was in line with average job growth in recent months, but below the average monthly gain of 202. Next week's inflation data will now be the final determinant. I don't think that there's enough room for a deviation in those numbers to change them to 50. I really think it's going to be 25. No compelling obvious case in the 25 versus 50 basis point cut debate, but nothing there to deter the cyclically driven, more bearish dollar outlook. Whether the Fed starts with 25 or 50 is no game changer in that respect. Meanwhile, BlackRock PM Jeffrey Rosenberg told Bloomberg TV that the danger is if the Fed goes by 50 basis points this month, it could suggest concerns about the economy rather than providing reassurance that policymakers are acting in time to head off a recession. Oh, that's a really good point, is that 50 basis points would be viewed as panic. I would, because honestly, just thinking for myself, I've been sitting here thinking, what if this jobs report is really, really bad, and then the Federal Reserve does do 50 basis points, and like we're headed for a recession? And I've been feeling the anxiety about it. It's just like we're like really on the edge. But I think I'm feel a lot more confident after these set of numbers that like we're not there yet. That so far everything looks okay, and we are going to start reducing interest rates. So we'll see. In short, it is safe to say that it will be 25 basis points absent some upside shock in next week's CPI print, which would crush the Fed's easing plans. That about covers it for the key aspects of the jobs report. However, there is much, much more. Looking below the surface reveals some catastrophic data. Surge in part-time jobs, a plunge in full-time workers, and a record surge in foreign-born, mostly illegal immigrant jobs, offset by a collapse in native-born workers. Post coming up shortly. Yes, well, what I kind of see is an economy that continues to chug along, and if you own assets, you're probably really happy, but everybody else kind of getting screwed, especially if you're working class. So, that is the conclusion today. Well, I didn't even know, like the big thing was also when the treasuries turned there, the SPOOs turned down in a very decisive and ugly way, erasing the gains that they had and going down to 44.50, 54.50. That's got to be them realizing like, no, it is going to be. Well, that's interesting. Could it be that they decided, oh, they're only going to do 25, not 50, but then because the dollar dropped so much from there. Well, why would that cause the dollar to drop though? Well, I don't know. I can't completely sort it out. But it was equities down and treasuries up. Equities down, dollar down, treasuries up. It's kind of an odd correlation. The initial one where it's like, yeah, the dollar shouldn't be moving. Like if we were going to say, yeah, this is going to be, they're only going to do a 25 basis point cut. Wouldn't that be stronger for the currency? So this initial move up is correct. So what's the pullback? It's just a pullback. But if it's just a pullback, why did the S&P 500 react so poorly to it? I don't know. Wide range, yeah. The more trendy the day is, the more I want to have been involved. So when you have a day that shoots up almost a handle, then comes back a handle, and then comes back up a handle, and I didn't trade it, I am perfectly happy with that. That is really difficult action to catch. You're not going to catch the turn every time on those. Those are really hard to trade. Really, really wide range like that. That's these really strong trendy flows. That's hard because you've got you're trying to pick spots where it's going to turn around without a whole lot of information to be able to pick those spots. Oh boy. But you know what? I think this also means that we're probably going to continue to see elevated activity levels next week. There may not be like many huge questions left, but there's probably still going to be some major moves that need to be made. They just might not be able to make them today. So that's also one of the things that goes on is again, there's kind of a limit to how far they can go. So I think that there was some selling, like on the pushback here. You saw buying in the 30-year, but not in the treasuries overall. So this is a situation where, the liquidity holes and everything kind of prevent them from being able to price something in all in one day. So a little fly from my plant. Anyways, So this is one of those cases where, I think it's going to take them several days to get there. So, and there's probably going to be a couple of twists and turns in the order flows as it does it. It will probably mostly be the stock market with a major adjustment. Well, I don't know, man. Like, so tell me, TLA trader, what price, if you were to say, I have a magic calculation machine that tells me what price the S&P 500 should be at based on all available information, and we are currently at 54.37, what price do you think we should be at? We're sitting right there at what, 100-day moving average? So if we were to go down to a 200-day moving average, we'd be at 52.73. Is that, because that would be like a major adjustment from here. Because when I look at the treasuries, I'm saying I think the treasuries will come back to 113 potentially over the next week. AO says less than 5,000. Oh, okay. That's a big. That would be almost half of the year's gains. I don't know about that one, guys. Here's what I'm thinking. I'm thinking this move down was when we started to get data that said maybe the economy is slowing too fast and we could get a recession. And then this is like, oh, well, we get 50 basis points and it's going to be okay and yada, yada. So I have a hard time seeing it just off of that getting lower than 5,100. But, big buts, there could be so many risk events happen, right? Like, just as an example, interest rates don't decline as quickly as people want, and a bank has to throw in the towel. So you see more bank closures. Or there is some sort of major geopolitical event that roils markets. Or the market gets really roiled by what's going on with the presidential election. It's fueled by easy money and zombie companies? Well, yeah. But this is like, this whole thing is, again, the market's not efficient. And so the thing that everybody's been saying is like, oh, well, prices aren't what they should be. So that must be because they're being pumped up with money. Ergo, they eventually must be forced to stop printing money and they'll eventually come back down. But I say that's not actually the case. Like I say, as long as we're not seeing inflation, they're going to continue to print money. And that you're going to continue to see that flood into assets. And that's actually a good thing. Like the more money that we have going into investing in these assets so that we can build innovations and create a more efficient economy, those are good things. So long as we're not also at the same time increasing the amount of the economy that is actually a direct result of money from the government, from government spending. That's bad. But I don't think that there's necessarily anything that ever has to make it, quote unquote, come back to reality, because that's never actually was the reality. The reality always was, throughout all of history, that what determines where it goes is the orders, and thus the amount of money in the money supply. It will probably be layoffs and company bank. Well, let's see. Could get worse. But, I think that them cutting interest rates soon should, I think, like, especially in the housing market, man, right now, I got to get going. But, like, is the middle class dream dead? Well, for most people, it is. Like, really, to have that middle class, upper middle class life, you need your shelter costs to be below 30% of your monthly income. Good luck doing that in this current economy with these interest rates. If interest rates come back down, that will help. That will help. It will still be hard, though, because there's just not enough supply. So we do need those rates to come back down to a more reasonable level. See if it's enough. All right, guys, I got to get going. I will see you next week. In the meantime, stay excellent.